Hi, everyone. Welcome to our April 2026 investment webinar. Markets had an eventful Q1, and we've seen even more action throughout April. We're here to give you an update and explain a little bit about how we're navigating portfolios. So to start off, I'll turn it right over to Jordan for a Q1 recap.
Thanks, Matt. Let's start with Exhibit 1, which shows year-to-date performance across the major market indices. As you can see in the yellow bars, the first quarter was negative for stocks, owing to AI-related concerns that we'll cover later, as well as rising geopolitical tensions tied to the conflict in Iran. Bonds slipped a bit as well, with the oil shock pushing inflation expectations higher and nudging interest rates up. Consistent with the short-term nature of past geopolitical shocks, however, markets bounced back quickly. The green bars show a recovery so far in the second quarter, owing to ceasefire discussions, with the major markets now positive for the year. Now, looking ahead, we're mindful of the seasonal weakness usually seen in midterm election years. Exhibit 2 highlights this, with the yellow bars showing the tendency for drawdowns. But as seen in the green bars, markets usually rebound as election uncertainty is lifted, more than compensating patient investors for any short-term weakness. As a result, we remain invested while maintaining the diversified posture that helped us navigate the first quarter. I'll be back later to discuss the first quarter market dynamics in more detail, along with some of the opportunistic adjustments made. But for now, I'll hand it over to Tom to walk through the economic and fiscal backdrop.
Thank you, Jordan. In terms of the U.S. economy, the word I'd use is resilient in the face of heightened policy uncertainty. And there's two main reasons. One is the consumer enjoying the tax benefits from the One Big Beautiful Bill Act. And the second is higher business capital expenditures related mostly to AI spending. So that's keeping the economy relatively solid. One concern is the rise in oil prices related to Iran and specifically to the closing of the Strait of Hormuz, where about 20% of energy moves through. What we wanted to do is address specifically, is this the potential for a 1980s-like energy crisis here in the United States? What's different is what we see here in Exhibit 3, and this is the energy intensity in the United States. And what you can see over this period, starting in 1975, this shows the amount of energy needed to generate $1 of real GDP. What you can see is that number has gone down substantially over the past few decades, and that's for two main reasons. One is we've transitioned to more of a service-based economy here in the United States versus a manufacturing-oriented economy, and also the adoption of energy-efficient technology, things like EVs and appliances. And so as a result of that, our usage here in the United States is not what it was back in the 1980s. The second thing is that we're now a net exporter of crude oil and natural gas via LNG. As a result, we're much less reliant on the Middle East, especially when you compare that to where we were in the 1980s. So it's a very different environment. Nonetheless, we are concerned about higher energy prices, and it is one of those policy uncertainties that we're monitoring, to which we look at Exhibit 4. Now, what this is, we're tracking the daily U.S. policy uncertainty index. What we found is, when you look back, is whenever that index goes above 200 and then peaks, the subsequent equity market returns are relatively strong. And now we're not going to go through those numbers here. It's on the screen and it's in the letter. But nonetheless, we've seen that. Like, for example, last year in April, when tariff uncertainty was at its highest, that number hit 545 on the index. Subsequently, once it peaked, the S&P 500 was up 28% through year end. Now we're at about 382, so well above that 200 level. And what we would anticipate is once we see that we get a resolution in Iran and that uncertainty index starts to move down, that should translate into better stock market returns. So again, these are things that we're watching closely, but energy has an impact. And to discuss that even further, I'm going to turn it over to Matt.
Thank you, Tom. Yes, energy definitely had a lot to do with the action we saw in interest rates in Q1. So just jumping right into the chart on the left, this maps the market's expectations for the amount of 25 basis point interest rate cuts by the Fed by the end of the year. So you can see to start the year, the market came in expecting about 2 to 3 25 basis point cuts. And this was pretty much within reason, given, continued moderated inflation and a resilient, but not totally strong labor market. And you can see what happened was that totally changed after the attacks on Iran and the spike in oil prices that you mentioned earlier. So the market went all the way from expecting 2 to 3 cuts all the way to expecting 0 cuts, and it's kind of been moderating around there ever since. So, obviously that has implications for interest rates, and we saw the biggest move on the shorter end of the yield curve, which is more linked to expectations for Fed policy. So while oil was a big driver of interest rates, credit markets also had an eventful quarter. And this was heavily influenced by AI narratives. So first, increased scrutiny over AI spending led to an orderly widening in credit spreads among hyperscalers. Meanwhile, concerns that AI will challenge software businesses contributed to concerns about private credit. Private credit funds are major lenders to software businesses, and there were increased concerns that AI will really challenge those business models. So in addition to already existing concerns about liquidity in private credit funds, these funds saw increased scrutiny and increased redemption requests as all this AI narrative and concerns about the software businesses were going around. So thankfully, United's clients benefited from our higher quality positioning. And this is really, to sum it up, explained by the chart on the right. And our decision making has largely been informed by this. So if you're looking at the green line, this is showing you credit spreads, which is basically the incremental yield that you get for buying a corporate bond relative to a treasury. And the compensation is really not that high. So we saw a little bit of spread widening in the hyperscalers, but really not enough to warrant a larger scale move into lowering our credit quality and looking for higher yield. So the higher quality positioning really benefited as spreads were widening out in Q1. That's not to say we didn't find some opportunities. We still like longer term municipals, which have been impacted by other things, but we're seeing value there. And more recently, we added some preferred stocks, which have benefited from higher rates and a little bit of spread widening that we saw. So that's a little bit of the recap of the bond side of things. But to turn the focus back towards equities, I'll turn it back over to Jordan.
Thanks, Matt. So this section will cover AI as well. Now, while markets were modestly down in the first quarter, we saw a more notable disconnect under the surface. So Exhibit 7 plots various segments of the market against changes in growth expectations on the horizontal axis and changes in valuation multiples on the vertical axis. And as implied by the downward sloping trend line, companies with strengthening outlooks saw the most multiple contraction and stock price pressure in the first quarter. This was especially true for large cap, growth-oriented tech stocks clustered in the bottom right quadrant. We attribute this multiple contraction to the transformational nature of AI, which makes it increasingly difficult for investors to forecast out year profits. The Great Eight sold off about 10% as investors questioned the long-term payoff on their massive AI capex budgets, while software stocks were down over 20% as investors weighed the long-term risk AI poses to their profit pools. With the Great Eight and tech more broadly making up a large share of the market, it was encouraging to see the stock market hold up relatively well in the first quarter. A big part of that resilience came from the more traditional old economy sectors of the market, as investors seeking protection from AI-related uncertainty ended up bidding up the stock prices of businesses with tangible assets that are harder for AI to displace. These asset-heavy companies, often referred to by the HALO acronym, heavy asset, low obsolescence, are also benefiting from more onshoring trends and supportive tax policy. So moving over to Exhibit 8, it ranks different parts of the market by their exposure to these capital-intensive businesses that are currently in favor, relative to the capital-light businesses facing perceived AI risk, like software. And as you can see, many of the asset-heavy sectors sitting near the top end of Exhibit 8 held their value in the first quarter and are also sitting at the top half of Exhibit 7. So, what does all this mean for our client portfolios? Having entered the year with a more diversified posture versus what has become an increasingly concentrated market, our clients have benefited from the healthy exposure to more traditional, old economy sectors that held up relatively well. Now, while we fully recognize the uncertainty AI introduces, it's hard to square the idea that AI is both powerful enough to hollow out software economics, yet somehow weak enough to disappoint the hyperscale cloud providers building it. The reality is likely to be far more nuanced in the long run. So while we're maintaining this diversified stance, we also took the opportunity to add selectively to tech at more reasonable valuations that are likely to de-risk those positions going forward. So with that, I'd like to send it back to Tom to close us out.
Okay, thank you, Jordan, and thank you, Matt. As you can see, to sum it up today, there's a lot of moving parts that the investment team is navigating through to manage client portfolios. So everything we discussed today and more, including a section on financial planning where we discuss tax management, are all included in the letter. And so if you have any questions or you want to dive deeper into any of these subjects, please reach out to your relationship manager and they'll be glad to dive deeper with you. So with that, we appreciate your time and we'll look forward to seeing you again next quarter.